I think we had a rather hot PPI. Certain metrics we haven't seen ever. Granted that this PPI calculation only goes back to 2010. And housing, whether you looked at starts or permits, basically both at 13-year highs. My question is specific. Interest rates haven't moved. They're exactly the same place now as before the data was released. What do you think about that?
Yeah, the numbers are very strong. I mean, we saw a big jump in PPI and the housing start being so strong, and still the market doesn't really want to reprice the Fed. It tells you that the market has a very, very strong view that it's very difficult to see the Fed raising rates anytime soon. We did have Mester also on the tape earlier today. She did talk about some of the preconditions for getting rates to move to the upside and move to the downside. But it does tell you, Rick, very importantly, that it's very, very difficult to get the market out of this idea that the next move from the Fed will ultimately be a cut.
Now, Torsten, let's dig down on something you said. You said that rates didn't move because it's going to take a lot to get the Fed to raise rates. Well, the long end isn't supposed to be about the Fed. It's the short end and the complexion of the curve that's affected by the Fed. The long end is supposed to be our barometer on economic activity, and it's failing miserably.
Absolutely. I mean, the issue here is that long rates should be moving when the inflation data surprises to the upside, in particular the magnitude of the surprise we saw today. But what I think is that the mindset of investors and almost all client conversations I have at the moment is about the review. It's about the idea that, well, we are a little bit on pause here while we wait until what the Fed will do once they come up with a review in June. And the general idea and the general message Powell has said repeatedly and from several FOMC members is again and again that, well, when the review comes out, we will sit around the table and we will say, well, we concluded that we don't really understand why inflation is still so low. So the expectation clearly is that the review will result in, if anything, the Fed cutting rates and lower rates because the inflation process has been so disconnected from what's been going on in the economy. So that's why the data today, as strong as it wasn't really able to shake the tree much and get the bears out. It really has been a very significant development that the data doesn't really matter. The narrative is so strong.
Here's the irony here, though, is that so many investors now use the long end, low rates as a reason they think that the economy is destined not to continue the expansion at the same horsepower, which leads to another question. Central banks, monetary policy is very easy right now. Central banks have been easing lots of stimulus, and as their balance sheets go up, ooh la la, stock markets correlate with that. Is that the reason the Fed never seems to want to assign blame? Because basically they're at the epicenter of the distortion.
Well, and as you know too well, and as you have debated repeatedly, the question is, when the balance sheet expansion ends, potentially this summer, I mean, what will then be the outcome? Is this QE4? Is this not QE4? The very big issue when it comes to the minutes today at 2 p.m. will be all about, will we get more details about what will the end game look like for this balance sheet expansion? Remember, the Fed at the moment is buying T-bills when they mature after 4, 6, 8 weeks. What will happen to the proceeds? Will that be distributed further out the yield curve? Will we see more buying out the yield curve, like 10-year rates?
Well, if history's any guide, Torsten, what'll happen is the market will have a fit and the Fed will ease more and other central banks will follow and currencies will get distorted. We've seen this movie before.